Today's market call is presented by Robinhood. Elevate your trading with Robinhood Legend, the sleek, free, customizable desktop platform built for active traders. While there is no cost to use the Legend platform, there are other fees associated with your brokerage account. See the Robinhood Financial Fee Schedule for more information. Speaking of sleek, this is the market call, 11 a.m. on the East Coast, 8 a.m. on the West Coast. No idea what happens in the middle of the country. And that's not to cast aspersions, but I'm not very good at that whole mountain time, central time thing. Hello, Dan.
I'm doing well, Guy. You didn't ask, but I'm doing well.
Dan,
here.
How are you doing?
I'm doing great, Guy. That whole flyover thing, sometimes some people actually take it the wrong way. If you are like a coastal elite like yourself, you know what I mean? If you say the flyover, it sounds dismissive. That being said, the heartland, and you and I are both from this fine East Coast. I love it, man. I love it. Whether you're in the central time zone, whether you're in the mountain time zone, and then you get to the West Coast, the left coast, as somebody likes to say. I love the left coast.
But there's just a lot happening on everywhere.
And every coast, everywhere in between. We love it. We love America. All right. What do we got?
Well, we're going to come in hot today because we're going to look at some charts and we're going to look at some trades because there are some things happening today, despite the fact that it looks so calm below the surface. So I think we should take a look at some of the things that we've sort of drawn up. Oracle's the first on our list, and look, that's a name that's been, in a word, parabolic. And I think you've made the point that, it's a fine company, but it does not deserve to be trading the way it does. And, they roll up a lot of things. There is a growing excitement around AI and around maybe some of their other things on the software front. But, this stock to me, which is, by the way, a name that I've liked for a while, but I didn't see it doing what we're doing here, has gotten a bit ahead of itself. So, you look at Oracle, you look at the backdrop of a broader market, and you say that gap fill, which is probably going to coincide at some point with a 200-day moving average. Obviously, the gap fill doesn't move, but the moving average does. I mean, it's very reasonable to think a stock trading in the mid-230s could have a move down to the sort of 175 or so, Dan.
Yeah, I mean, one of the things that I would almost say that 200 level, the breakout level, right? And then you just saw that sort of continuation, and here we are. The news flow just keeps going and going. One thing I would just say, if Jacob wants to let me drive here on Legend, one of the things I would just say here, and let me just kind of pull it up. The chart here. So I'm looking at this, obviously the same thing that you were just looking at here. If I draw like a horizontal line, that gets me about $200, Guy. If I can, and I can just draw that if you want here. You see that? So it's about $200. I mean, to play for a move back from, let's call it $250 to 200, you could say, well, that's a lot. I mean, but look at how much the stock has rallied. It's gone from basically, I want to say 120, to 250 or something like that. And this is where, let me just go to the options chain for a second. It's like, I guess it might be a really hard time to buy premium if you think about it, especially in some of these names that have had great upward momentum here. You could say, well, why are you trying to just throw good money after bad if you're just buying put spreads? I mean, one of the things you could definitely do is sell a call spread, which might not be that sexy depending upon how you size it. But the other way to think about it is maybe buying a put calendar. What are you doing a put calendar? You are selling a shorter dated put and you're buying a longer dated one, and what you're trying to do is play for the stock to go towards that kind of put strike that you're short dated, longer long dated, and basically have that shorter dated one help finance the longer dated one. So have that sort of expire if it gets towards your price. So let's just look at this around $238 where we are right now, Guy, and I might look to target, let's say, a $230 strike. I might look to August expiration. If I were to sell the 230, and maybe that's a little tight, let's go down to the 225. Okay, if I were to sell that, maybe it's 320 or so, and then I'm going to kind of go back out to September expiration here, and I'm going to look at that same strike, and I can just use this sort of, you see that at the money little button there, Guy, that I'm highlighting there, that will take me there. So if I'm selling the August, 225, then I want to buy, well, they don't have it here. So that's a great, this is a great example of there's only $10 strikes here, guys. So let's go back to August expiration. Let's do 220 to the downside. All right. Maybe that's the level. Is that the level you got? Hold on. Let me just take a sip here.
No, water never hurts. So, I mean, you're talking about I mean, if you think about what the first level you're talking about is sort of that extension level that we built upon. I mean, that it makes sense. The gap fill probably has you closer to sort of the 180 level, but you got to sort of crawl before you can walk. So, 220, I think, makes some sense. And what Dan was saying is by selling the shorter dated put, you're basically financing the longer dated one. And part of this play is, quite frankly, you hope you have a little bit of sideways to maybe lower action. That shorter dated put expires worthless. You collect the premium, and then the stock starts to move in your favor as we get closer to September. I think you've had your water by now.
Yeah, but you know what's really interesting, Guy? So you were the #1 fill-in for 10 years on options action. And I know you traded the options back in the day.
I understand it.
But that was brilliant. I mean, that was brilliant. So this is a great example, Guy, though, of where in one expiration, you have $5 wide. In another expiration, you have $10 wide. And, you can do something they call a diagonal. I want to get in the weeds here. But listen, let's just focus again on that chart. You talk about that gap, which is all the way down there at 185. You look at that 200-day moving average, which has been rising. If that's your target, I think to target that in a month is too short. To target it maybe in 2 months is probably the right sort of time here. So if you wanted to own a put and play for that range between 200 and 180, let's call it, okay, then you want to kind of finance that one. So let's look down to, okay, the 220. I'm going to go back to August expiration here. The 220 put is bid at, let's just go there for a second. 220-ish. Okay. Now I'm going to go to September expiration, and I'm going to look at the same strike. I'm going to look at the 220 put here. I'm going to go to at the money, and I'm going to go down a little bit here. And you see what I'm doing. I'm buying that. That's 820. So selling the August 220 put at 225, buying the September 220 put at 813. That costs you about, let's call it 589, 590 or something like that. That is my max risk. So this is how I would look to play a stock like Oracle, if that makes some sense. Guy, I'm looking at, if we want to go back to the main page here, I want to just show you some of my some of the things I'm looking at. I mean, if I'm looking at, or maybe we just bring up the S&P 500 for a second today, Guy, because this is one of those sort of interesting days where I'm looking at mega cap tech, which is down,
underperforming.
Yeah, semis are leading to the downside. I see some software strength, which is kind of interesting. Some of the names that have acted very poorly of late: Salesforce, Adobe, Workday, ServiceNow, they're all up on the day. Some of the internet stuff is still doing okay here. I want to look at Netflix for a second, because I know this is one that you've been focused on. This is like tippy-toppy here, Guy. This is like tippy-toppy on the internet space here. Look at that uptrend.
Tippy-toppy, that's a financial term.
Well, it's down nearly 10% from those recent highs. I know. And a lot of folks thought that quarter was just fine. They didn't love the guidance here, but it's broken that uptrend. It broke that uptrend since earnings. You see that rising 200-day moving average. Maybe the target is that sort of breakout level that we saw, you know what I mean, in late April. One of the other things that you and I have mentioned, this is one of the very few mega cap tech stocks that never broke its 200-day moving average during that April swoon. So thoughts here on what you thought about the earnings and the guidance, and then the technicals here.
Well, we talked about it into the earnings, and we said collectively it's going to take a lot for the stock to continue the move. And what we have seen before with Netflix is, these moves into earnings, a little bit of a give back, and here for you t-shirt fans, that's a static chart. But if you look at sort of a longer term duration chart, you'll see what I'm looking at. And you have seen pullbacks along the way. It's not like this is the first time we've seen these little sell-offs post earnings in names like in Netflix. And I just think this is just my opinion. Personally, I think it's just sort of run-of-the-mill little sell-off post earnings before it gets its sort of mojo back. That's me. There are other people that say valuation doesn't make any sense. YouTube is catching up, if not past Netflix. So YouTube is obviously a threat along with sleep. I mean, there's a lot to like, I think, in the form of valuation. There's some things to be concerned with, but I'm not overly concerned in terms of the stock performance yet.
I look at this and I say, I don't like it. If the news is so good, right? Like, why isn't the stock acting better? So I think there's plenty of folks who are probably saying maybe there are some better ways to play, at least the growth in this space. And, Google's going to report tomorrow after the close. And you just mentioned YouTube. We had a conversation on Fast Money the other night after the earnings, and it took us 10 minutes into the Netflix conversation after the earnings report to even mention YouTube. And I think that's something that I think is probably on the tip of a lot of Netflix bulls' tongues here a little bit. And after the move that it's had, off of that kind of, what was it, 850 or something low in early April. And then here we are, we were at 1350 just, 2 weeks ago. I think you look at this, let's go back to a 1-year chart for a second. This breakout level from late April that we just talked about, that was basically 1070. And you see that 200-day moving average, it's about 1,000 right here. I think you can play for a move back towards that. Let's see how it acts. It's right through that 50-day moving average. You have 2 closes below that. If it closes there today, 3 closes, it's just a loss of momentum that we have.
Yeah,
right
listen, no doubt about it. And listen, there's going to be a point where my lack of concern turns into concern. I don't think we're there yet. And you'd be like, well, that's a dumb thing to say. Not necessarily, because, if you have a thesis behind a name, you're going to obviously have to endure some of the downs along the way. And that's what I think we're in the midst of now. But if Dan's right and there's this lack of momentum, it starts to build. I mean, as he's pointed out a number of times, Netflix did have a huge, and when I say huge, a significant peak to trough decline back in 2021. Then you can say that's sort of, that was the time we were living in. But I mean, it's that stock went, I think, Dan, from about 700-ish. I think it traded as low as about 175 or so at its trough, sometime in the spring of 2022.
Here's another name that I think is pretty interesting, and this is at least another sector guy that's acting really well today on a day that the S&P is kind of flattish, and that's retail. And we highlighted a little bit of a few of these names the other day, but I want to take another look at Target for a second here, because I think Target is one where the sentiment is so bad. I think we talked about it yesterday. There might have been another downgrade, wasn't there? I think that's what we were highlighting yesterday.
90, I think it was a $91 price target. We talked about the number of holds and the number of sells. And, despite the fact that this stock has been a complete underperformer, you still have people sort of piling on the downside.
Yeah, and so to me, I look at this chart. This is a 1-year, right? I look at that breakdown that was about $120 or so. You see that 200-day moving average that's been working lower. I mean, one of the thoughts that we've just had is that everything has been so bad. Let's go to the 5-year for a second, then we'll go back to the 1-year. It's been so bad under the 10-year, or at least over the last 5 years of the CEO, Brian Cornell. And there was a time where he was thought to be one of the best operators in retail. And I just don't, and I know you feel the same way, you can't look at this 5-year performance and say that this has been a good operator, right? In almost any environment, like it was a good environment during COVID, then it was a bad environment post-COVID, but then there's a lot of companies that figured out an inflationary environment, Walmart, Costco being 2 of them, how to operate there. I look at this 5-year, I look at the downtrend guide. Let's go back to the 1-year. And I say to myself, this thing looks pretty good. I mean, you can say, well, this is not a great bounce off the April lows, but at least it's trying to kind of put in a low, and maybe there is one less bastion. Maybe there is some sort of activist that gets involved, pressure to get the CEO out of this thing. That's what we talked about yesterday. I think you have a stock going back towards that 100 or the 200-day moving average in that scenario.
And I think what you're saying is, look, I don't think Dan is suggesting the company's fixed by any stretch, but what you are saying is, you get a modicum of good news here, and a bounce from 105 to sort of the 200-day moving average of 120 is not out of the realm of possibility. And, that's not a bad little trade in the short term. So I'm not going to disagree with you entirely, because I totally understand what you're saying. What I will say, though, is I think the problems at Target are significant. And I'm glad you mentioned Costco and Walmart. And if our crack staff back in wherever they are today, that would be Stephen, Jacob, Timmy, Bill, whomever at CC, pull up a Target chart and then throw up Walmart and Costco at the same time over the last 5 years. And if you look at those 3 names, I mean, you can just see what I'm talking about. I mean, I think the green is Costco. Obviously, the white is Target. You want to throw Walmart, it's going to look very similar. And at a certain point, and I've made this abundantly clear, at a certain point, it's on the operator. And, I am fully throwing the blame at management, because they missed the boat over the last 4 years, Dan.
Yeah, no doubt. But here's the thing, being a little bit contrarian, and maybe it's not being that contrarian with the way the stock is kind of holding in there. You look at some of the technical levels. I think about this as like next earnings report, guys, on August 20th, right? And oftentimes you will see some sort of building of, at least a sentiment towards some sort of change into an earnings period. And so I want to isolate August expiration. And this is pretty much a pretty easy trade if I can kind of operate the legend here again. So this chart doesn't look too different than the one that we just showed you here. I like the candles. I like the way that it's kind of showing this kind of series of higher lows, right? A series of higher highs here. We already talked about the levels in which I am targeting. And so this is one of the ones, you see what I did there, the targeting. If I go to the options chain,
Clever.
and I just want to look at, okay, so here the stock is about 104.5. All right. So let's just go down to August expiration. That's September. Let's go to August expiration. I'm going to play for basically about a week before their earnings. Okay. The 105 call is offered at 325. I can probably get that somewhere in the middle. If I do the math on that, it's basically like 3% of the underlying stock price. If I were to buy that, let's just call it at 320 or 315 or something like that, and I'm break even at the strike, which is 105 plus the premium paid. So let's just like look at this right here, and let's look and see what we could pay for this thing. Let's go down to, let's say 315. So I'm just let's just throw in a 10 lot here. And bam, okay. I was filled. This is really important.
You got smacked immediately.
Well, it was 310 at 325. And this is a great example of, there's obviously a 15-cent spread there. I'm not going to just go pay the offer, right? So in this situation, if I had to, like, if I was like so hell bent on buying this option, then I might have paid 325 or bid 320. But I bid 315. So that is what you said. I got
right. So stop there for a second. And I think this is a good lesson for people that may be new to this. Your instincts, or if you haven't been, look, both of us have been doing this a long time, and I'm not trying to be condescending at all, but I think the instincts suggest if something is offered at a price, you want to buy it, you buy it at the offer prices. When you walk into a grocery store, you're not negotiating how much you're going to buy your bag of double milk chocolate Milanos for. However, in our world, there's a bid and an offer. And, if you continually pay the offer or hit the bid, you're giving away a little bit, and each day, if you're doing this daily, that little bit you give up each day adds up. As Dan just showed you, and this happened right before your very eyes, he basically bid in the middle of the bid and the offer, and he immediately got smacked. Now you say, 10 cents is not a big deal. No, but over time it is. So lesson learned here, sometimes you have to massage these things a little bit as well.
Yeah, and I think this is another opportunity to kind of give a little bit of a inside baseball here. This delta, if you look and see where my so the delta is basically like 49. Okay, so that's basically saying it's got a 49% probability of being in the money on August expiration. So it's also very sensitive to price moves, right? So if the stock comes in, let's say 20 cents, right, that option is going to move commensurate with the 50 delta, right? So that's how, if you're playing inside the spread. So right now with the stock at 104.40, I think the stock was trading a 104.55. Now we see the market at 305, 320. So there's that. That's how I'm thinking about target. Now, what am I going to do here to risk manage this trade idea? If I am getting towards, like, let's say a 50% premium loss, I will look to cut that trade. If I am basically back towards not back towards, but near my break even, which would say 108.15 or something like that, I may look to spread it by selling a higher strike call, creating a call spread, locking in some of those gains, reducing my premium at risk. Or I may roll up and out, because if it's something that, I'm doing well in this trade idea, let's say the stock is at 110, and I'm like a week before earnings, I might look to kind of roll that, let's say, to the, I don't know, well, let's call it the 115 call into the earnings print, or so, something like that. So again, I just wanted to kind of detail how I'm thinking about target, how I like the technicals, how I like the sentiment, how I like the potential for some sort of management trade into earnings. I also like the thing that everyone hates it. So that's
and it clearly is a counter into what people are talking about. You want to be somewhat, you want to sort of look to the other side of this thing. We've seen it before. So I like what you're doing there without question. I will tell you, there's a very good chance this is going to be right. I think 3 to 6 months from now, we're talking about a stock that's, double digits in terms of sort of 85 to $90, and then we'll talk about it again. Are you familiar with Wavy McFly?
Yeah, he's here every day. He's the
Well,
man.
throw up this question because we were in your head, Wavy. And thank you for this. Dan and Guy talked about the NASDAQ close in NVIDIA yesterday. Well, we happen to have an NVIDIA chart at the ready. We saw the same thing that you saw, and there's a pretty steep uptrend. Well, pretty steep, I guess, is an understatement. I mean, this is a stock that basically has doubled since the April lows, which is remarkable given the size of the company. But here we are right at that trend line. I'm seeing what you're seeing, obviously a little bit of underperformance today. And, think this trend line is legit. And, we'll see how it plays out in terms of whether and how we close today. But yesterday's close wasn't great. Today's price action, not great either.
All right, let's do two things. Give me a 2-day or a 3-day chart here. I just want to kind of show just the kind of volatility that we've seen just over the last few trading days, right? And so I'm looking at this thing. It traded as high as like 171.30 today, or 171.34, traded as low as 165-ish or something like that. So you see it's bouncing a little bit. Now let's go back to that 1-day chart, but let's kind of make it so we can manipulate it a little bit here. So this to me is really interesting. All right, now let's go to a 1-year chart. Sorry about that. So you see it getting towards that little moving average there. Okay, let's draw a horizontal line at the breakout level. What was that guy, like 150 or something like that, right?
153 was the prior high. So yeah.
All right. Now, if you were to look at that uptrend that we had, to me, I think the idea of playing for a move back towards that 200-day moving average, a retest of that sort of breakout level, because maybe that 200-day guy is about there by the time, we see that sort of retracement. But this is another one, just like we were looking at that sort of put calendar at Oracle. This is the sort of trade idea I would consider here. Let's see how this stock trades into the close. But if it closes weak, this is one that I think you want to put a little pressure on. So that's Wavy. That's how we're thinking about it.
Matt Walters here as well. He's in every day, and he's talking about the return of the meme stocks. It's like the audience is in our head today because we have a couple charts that are talking about just that exactly. I mean, if you look at this open door, for example, it's hard to say this is anything but a meme stock. And then today, Kohl's is getting sort of the meme treatment as well. And that is not our headline. That's a Bloomberg headline, Dan. So I don't know. Listen, I think I know what this stuff means, but in today's world, maybe it doesn't mean anything. Maybe that's just the evolution of the market and people trying to take advantage of momentum.
Well, I think there's a couple things. I think in both of those stories, there was no momentum. Like, look at how poorly those stocks were trading. And in many ways, look at that Kohl's chart doesn't look too different than the target chart. And that's one of the reasons I want to be really clear about this, why I didn't enter that trade as a call spread, why I didn't sell a put spread, because this is the sort of thing where, Target could be up 10% on a whole, not a whole heck of a lot of news. So what's interesting also to me on such a short period of time, how Kohl's trades this way or Open Door trades this way. Now let's flip over to a couple other meme stocks that became very big, but have actually stalled out. One of them was AppLovin. So I think Carter mentioned this yesterday when he was on. And AppLovin, and let's go back 5 years. I mean, this thing, look at where this stock went from, from its lows, and then it became a massive meme stock. Look at all that volatility, and the fever has definitely kind of broken there, guys. So you're seeing a rotation into some, out of some memes into some others. And then we had one other meme stock here that I think is worth highlighting where the momentum is broken a little bit. And that would be Dave. This is a fintech stock that actually absolutely went berserk. So, a few things here that are just kind of catching our eye. All right.
Did you see the movie Dave?
Yeah. I did.
I would think it was Kevin Kline, I believe.
Yeah, it was great.
If I'm not
he was
mistaken.
president, and then he got.
I think Sigourney Weaver was also in that movie.
Correct.
And the Dave, the actual Dave, did not get along with his wife, and then he passed away at a heart attack or something. And they found this look-alike, and they brought him in, and then he actually got along really well with his wife, and she was sort of surprised by the entire thing. And it was a really well done movie. Sorry. I don't think that's what the stock is about, but
that's amazing. All right, so we did a bunch of charts.
You know what? It's not amazing. It's just, you know, it is
All
what
right.
it is.
We did a bunch of charts. We did a few trade. We did one trade live. We did a couple detailing of some trades that we will come back to those names. We will come back to Oracle. We will come back to NVIDIA. We will keep an eye on these meme stocks. But guys, let's do a hard break here. So here we are. Today, it's just before noon. Okay, so the market's been open a couple hours here, and you know the S&P is down 10 basis points. This is obviously Tuesday, July 22nd. Yesterday, the market was trading pretty well. We highlighted the fact yesterday on the Risk Reversal Pod that we had 17 consecutive days without a 1% move. We've seen a bunch of new highs. The market is grinding higher. A lot of folks are looking at whatever level here. You know, we're 6,300-ish in the S&P 500. We're a little above that. Yesterday, we've given up a little bit about that. We're going into the meat of earnings season right now. We're past the CPI, you know, some of the PPI, that sort of, you know, some of that data. Everyone's looking forward to the Fed meeting July 30th. That would be a week from tomorrow, I think. Let's just throw up these dueling headlines here from CNBC, and I think they're really interesting. So here's Mohamed El-Erian. He's saying that the Fed, or at least Fed Chair Powell, okay, should resign to preserve Fed independence. I don't get that. I mean, you're going to have to explain that to me. And then the other one, Scott Bessent, who's the Treasury Secretary, right, who's definitely in the running for the Fed chair, okay, no matter what happens, you know, prior to this May 2026, a lot of thought has been that, you know, Trump is going to elect somebody or nominate somebody who will be like this shadow president. I wonder if Muhammad is speaking to one person and one person alone. And then the flip side, maybe Bessent knows to not be so political about this might give him an upper hand as you think about when the timing might be of a new nomination. Guy.
Yeah, I saw this today, and I'm not dropping names. You know Muhammad. I know him pretty well. He's been on Fast Money. He's been on the network for years. And, you know, I know he watches Fast Money, and I know he's a fan. And I'm a fan of his work as well. But this one came out of left field a little bit. Now, there's a part of me that sort of understands what he's saying. I think inherent in this, he feels, given all the rhetoric back and forth, I mean, maybe in some ways Jerome Powell's a bit compromised, not because he's a bad person or bad Fed chair, but because with all the stuff coming at him now, he finds himself in an impossible situation. Even if the data suggested to him that he were to lower rates, that's going to look like he caved regardless. And if he doesn't, it's going to look like he's just sort of, you know, basically Heismaning this administration. So he's in a no-win situation. He's been sort of painted into that corner. And maybe I think what Muhammad is saying, for the good of the institution, given some of the things surrounding him, maybe it is best for him to resign. By the way, I don't adhere to that, but I sort of understand what it means. Of course, incumbent upon that is who's going to replace him. So if the person that replaces him is, again, an independent operator that understands the integrity and the I guess the independence of the Fed, I guess it'll be fine. But if you just throw in a lackey that's going to bend to the administration, I don't think that's necessarily fine.
Yeah, I know you're not saying that. I couldn't disagree more with that. If you're talking about the independence of the Fed, the idea that a president could browbeat you out of there, I think is the exact, I mean, that is the exact reason why Powell has to stay the course. And so you and I have been talking about this for, it felt like since the last Fed meeting, which was, I think, June 18th, we're like, the rhetoric out of the White House is only going to increase into this meeting. If you look at the CME Fed Fund futures, they're basically saying there's not a chance, okay, there's not a chance that the Fed will lower interest rates by 25 basis points. The only way, in my opinion, that changes is if you see the rhetoric from Treasury Secretary Bessent, who's basically saying there needs to be an internal review, right, of what's going on at the Federal Reserve. The fact that they're using this as a cudgel, this kind of, there you go, there's a CME Fed funds tracker there, that they're using this, you know, rehab of the Fed building as a way to put increased pressure to maybe draw a line to the whole idea for cause. It just seems a bit goofy. I would bet my left pinky, or at least the tip of my left pinky, that Jerome Powell is not going anywhere unless there's some sort of, you know, this cause thing starts to build. And to your point, it starts causing a huge distraction for monetary policy.
So the tip of your left pinky is not necessarily a big bet. That's like sort of the, you know, table stakes, as they say. If you were to say, you bet your right arm. I mean,
Yeah.
that's a little bit different. I think that's, but I understand your point. Listen, I want to be crystal clear. I'm with you on this. I don't think Jerome Powell should go anywhere. I don't think that there's cause to fire Jerome Powell, despite what you're going to hear. I know there are a lot of voices out there calling for his firing. Tommy Tuberville seemingly every day tweets, "This is a good day to fire Jerome Powell."
Genius.
Pardon me?
Tuberville, genius.
Yeah.
I mean, he's exhibit A. That guy, if you ran and you say, I'm not always the sharpest tool in the box, you do say that about yourself all the time. You know what? That if you ran for Senate, you could win. How's that? Okay. Because if that guy's in the Senate, and I'm sure he was a great football coach. And you know, like this saying that you used to say, I'm sure he's a lovely guy.
Lovely guy.
I'm sure he's a lovely guy. Okay.
Bill Pulte's another. I mean, so you got a lot of piling on.
Pulte's the guy we used to have on Trading Spaces a lot.
Mm-hmm.
He went full on. He went full, like he's got a view here. That guy.
He's got. Well, he's. I don't know if he's part of the administration or one of those sort of tangential groups, but he's got a role. I guess my point is there are a lot of people piling on here, but it's really misguided because again, the belief that somehow the Fed, if they were to lower rates, that's going to be the salve that cures whatever ills they think are out there. And, it's really hard for me to see the compelling reason to change course at this point. Things are going okay. If it ain't broke, don't fix it. And I just don't think it's broke. Now, people will say things are slowing down. They have the ammunition. Save your ammo. And I've heard people say that other countries are lowering rates. We should act in kind. And it's like your grandmother used to say, she'd say, little guy, not that I was one to follow the crowd, but little guy, just because everybody's jumping off the Empire State Building doesn't mean you should. I'm sure you got that at some point as a child.
No doubt. One of the things about the inflation, and like you just mentioned, the idea of lowering interest rates not doing the thing that you would expect it to do, especially when you think what the Fed controls. You've made this point 100 times over the last couple of months. They can control the short end. They don't control the long end. The long end is representative of future growth as one of the main inputs. Our main man, Doug Cass at Seabreeze, he sent over a couple charts of the day, which are from our other main man, David Rosenberg. You just called him Rosie from Rosenberg Research. And, we'll put these in the show notes, guy. So Doug's sharing the CRB spot commodity index, and you're not going to be surprised by this, but since 2023, when the Fed had already raised interest rates to combat inflation, the CRB is trading very near those 23 highs. Yeah. And it looks like it's going to break. So that's the commodity index, right? And then there's another chart going back to 1981 that shows it on its way back to the 2021 peak. Mm-hmm. Okay, so inflation, at least through the lens of commodities, and then he has PPI consumer foods, that thing has gone parabolic since 21. These are all really important inputs to inflation. Maybe inflation, and you said this yesterday, maybe they had the opportunity to readjust their inflation outlook at one point over the last year or 2 years or something like that. They didn't. That 2% number, I think, is going to continue to haunt them, especially in an environment where we might be struggling in 2025 to get to 2% GDP growth.
Yeah. Yes, and yes. And maybe 2% inflation in today's world is a pipe dream. And I said it yesterday. There was a window of opportunity for them to sort of move the goalposts a little bit. I don't think they would have gotten fricasseed over it. That window closed. And now if they were to try to reopen it, they're going to get crushed. And for, for good reason as well. So we'll see. And I'm glad you brought up what Doug just sent you real quick, because I brought this up a number of times. When people think about inflation in terms of commodities, they look at one thing and one thing only. They look at crude oil and they say, well, crude oil is under control. Must mean what they're not looking at are all these soft commodities. They're not looking at the industrial metals that we spent some time talking about. That's a big component of that. And, this copper genie is way out of the bottle. We've talked about it for a while. So lowering rates in this environment is not going to, if you think it's going to help, it ain't going to help.
All right. So, Guy, that left pinky thing I just did there?
Yeah.
It must have been subconscious.
You have a pain in your pinky?
Last week, I was at this BAM Elevate. This is Balyasny's private investment tech conference. And there were two keynote speakers. This was out in the Grand Tetons. It was Jackson Hole. One of them was the great Steve Kerr. I mean, it was a fascinating
Love Steve
conversation.
Kerr.
I
Love
know
his backstory. Love everything about him.
everything about him. And you know what? If you've ever been in a room with him, and this was under a tent, it was a small group, this guy would have taken questions for 2 hours. I mean, like, he was happy to talk about anything from basketball to his background, you know, and he's got a great backstory, as you said, to what's going on with NIL. I mean, the list went on to social, the way he's been outspoken about that sort of thing. He was amazing. There was another keynote speaker the day before, a guy named Mike Horn. This guy, I'm going to tell everybody to go Google him. This guy, and you like this, what do you say? You say that guy's a badass, and you mean
Badass.
that. And then if it's a woman, you say she's an edgy broad. And
Edgy
you also
broad.
say, okay, this
I mean,
guy,
badass though as well. I mean, those are, by the way, those are, for me, that's about as high praise as you possibly can get.
I know. And so this guy, Mike Horn, he told us all these stories. He has circumnavigated the globe without any technology. He's gone across the North Pole alone, pitch dark, 2.5 months, tells all the story. How, yeah, this would be right up your alley, man. The way he has to train his brain, not just his body and all that sort of stuff. He was amazing. I mean, I could have listened to this guy like in a Joe Rogan style thing for 4 hours or something like that, but he had to take off one of the tips of his fingers and during one of these sorts of trips. And I'll let you guys read about that, but it's pretty interesting. Mike Horn.
I love that. Can I tell you something?
Yeah.
I love that
Guy.
You know, so this is now, it's 1980 or 81. And I'm sorry, Jacob. And I got my finger. I don't know if you can see that.
Oh my goodness.
Can you see that?
Oh my goodness. We're going to have to put that for you audio listeners.
I'm sorry. That's why I said I'm sorry, Jacob.
We'll
put it in the show notes. But I got it caught in a face mask and it was bending like at a 90-degree angle. Jeez. And I'm like, wow, that's pretty crazy. So I tried to fix it myself. I wound up having to do it because one of the guys on the sideline, when he saw it, he threw up. But I considered actually, like Ronnie Lott, and this is pre-Ronnie Lott.
He did that with the Jets
cutting my pinky off.
Did he do that with the Jets or did he do it with
the San Francisco?
By the way, I heard Ronnie Lott tell me that story. Ronnie Lott joined, this is about 20 some years ago. He joined, and Joe Montana was in it. They started a fund of funds. And so this is a great trick. So they would raise money and they didn't have a hard time raising money. You're these 49ers greats, that sort of thing. And then when they take that money and they would go to the, hardest to get in hedge funds, getting capacity. Well, if you walked into a hedge fund and you start telling your story about how you ripped your pinky off during a game in 1988, you're going to let them invest in your fund. So that was pretty genius stuff there. I also had a thumb thing guy. I was playing lacrosse, and back in Syracuse, we did not have turf fields. And for the first month of practice, you had to shovel, this is no joke, the parking lot, and you play on cement, and your bones are pretty brittle when you're playing on cement in like 20-degree weather. And I fell, put my finger down, broke my thumb. My coach, who was so old school, Tom Hall, just snapped it back into place, put a little thing on there. All right.
Isn't that great though?
We started this guy.
I'm a little screwed. I'm a little
twisted. Gotta go check out Mike Horn. You gotta. I was fascinated with the guy. All right. Another split screen guy. And I think this is interesting. So you and I have been talking about all these announcements, in the White House. We're going to do this over the next 4 years. We're going to spend hundreds of billions doing this, that, and the other thing. A lot of it is around data center and tech. And, Trump and the trade war had certainly valid reasons. The idea of kind of pulling back, manufacturing to the U.S. This is something that we all agree is going to be much harder than just, kind of laid out there. It's also going to be inflationary in the near term, all those sorts of things. But we had a lot of these tech CEOs go into the White House, make these big announcements. It was Apple, it was Stargate. So these two competing headlines got really interesting to me. SoftBank and OpenAI's $500 billion AI project struggles to get off the ground. Now, this is called Stargate. This was Larry Ellison, Masa from SoftBank, and Sam Altman from OpenAI. You remember that Elon Musk, who was in the government when this announcement came, he tweeted out almost immediately, they don't have the money to do this. All right. And then this is from the information. OpenAI greatly expands data center deal with Oracle. Okay. So you got this going back and forth. And, one of the reasons I bring this up, so we don't care about SoftBank, trades over there in Japan. They've also been associated with some of the biggest disasters. As you think about, like, WeWork was a big one of them.
They top tick WeWork. I mean, they invest, I think, with $51 billion valuation or something.
So who cares about Masa? But the fact that Oracle has run the way it has, it's doubled, you know what I mean, in the last 6 to 9 months or something like that. And they basically keep getting these data center deals. OpenAI, it seems very cozy there. But there seems to be competing narratives here, guy. There's what people are saying to get out there in front of the president or the administration in general, and what is actually happening under the surface. Because we can go back, I can't remember who it was. Somebody just recently scaled back one of the data center projects that they talked about building out or whatever. So a lot of it's political. And if people are making judgments about just valuations of these stocks and opportunities and TAMs, they might be misguided at this point.
Yeah. Well, yes, 100%. And, I've heard this administration say they have $16 trillion of investments coming to the United States, which I'm not really sure where that number comes from. By the way, this is a $27 trillion economy-ish. I can round up to 28, but you get my gist. So,
Yep.
But your point is well taken. I mean, the headlines are what they are. They get their basically photo op. Everybody's talking about it. The follow-up, though, there is never any follow-up. And this goes back. By the way, it's not just this administration, although they clearly do it more than others. I mean, the headlines are on the front page of the news. What never makes the news is the fact that a lot of times these things basically never happen. And there's a very good chance that all these things that have been talked about never come to fruition because, nobody's going to do the work necessary to see if there is a follow-up. And basically all this does is it serves two purposes. It gets the administration off the ass of these companies, and it gives the administration a win in terms of the populace. So it's win-win, but it's a lose-lose on the back end.
Yeah, no doubt. All right, last thing before we get out of here. We're getting into the meat of earnings season. Everyone's focused obviously on big cap tech. They want to hear what, CapEx looks like, what they're seeing as far as the hyperscalers growth within, those businesses, what they're basically assigning as far as revenue for resales of AI products and services, right? So there's a lot of things that you and I feel like the market is really hinging on in many ways. But let's take one step back to some of those bank earnings because, even if we saw some muted responses, I know Citi traded really well. These stocks are basically back to those prior highs, right? And if you were saying, well, maybe that was as good as it gets, and maybe these bank CEOs are not being as cautious as they should be about a consumer, maybe some of the pull forward in demand is showing a stronger consumer than we might have thought in front of tariffs and the like here. Are you surprised that bank stocks are basically back towards those highs? Because it just shows you that investors still want this exposure.
Yeah, yes. In one word, let me sort of pull back a little bit. In terms of Citi, no. And I think we've been consistent on that one. I think Citi, as we're sitting here, is making a multi-year high, which is not a big deal. I get it. But Citi to me is the one that sort of sticks out like a sore thumb, no pun intended, in terms of the performance that I think is going to continue. Some of these other names, absolutely. Like JP Morgan, we've talked about, Wells Fargo, Bank of America. You want to throw in some of the other banks, investment banks. I am surprised at the resilience without question. But, people have an appetite for banks. I mean, you're going to hear the continued story how basically well-capitalized they are, regulations being cut back, M&A opportunities, the ability to sort of free up capital to do things. The bull case. The bear cases are valuations for some of them in terms of price to book don't make a hell of a lot of sense. And, this yield curve, which seemingly works to their advantage, I don't think a lot of banks are necessarily prepared for 10-year rates going higher, which is still my base case. And Jamie Dimon has talked about that as well. So we'll see how it shakes out.
All right. One of the most interesting names in the space, obviously not a bank, American Express. They do take credit risk. That stock had just made a new brief all-time high earlier in the year. I think it had traded, the all-time high was somewhere
329, I think.
Yeah. Wow. Look at you. Look at you. And
All
that's
right.
where it was traded. Yeah. And so, made a little bit of a double top. It's down nearly 10% over the last few weeks. That 200-day moving average with the stock right here on 304 guy is basically 290, and that might be support. The stock got as low as I want to say 225 back in April. And the reason I bring this one up is like, okay, so you have Bank of America CEO Jamie Dimon at JP Morgan, Wells Fargo, Citibank, all these CEOs. We're talking about a consumer that's kind of hanging in there. That consumer is also an American Express consumer, but American Express, obviously a big part of that is business travel and a higher end or a higher earning sort of consumer. So what does that say to you? Is it Is it too much to just draw a comparison between those two? Because on the flip side, year to date, COF, the Capital One, trades a lot better than American Express.
I look at American Express. I get it. It's a basically it's one of these brands like Tiffany's was, like to a certain extent Disney was at one time. I mean, there's certain companies that are a brand in and amongst themselves. American Express is one of those names. I don't think the stock at these levels is not taking into consideration the potential for delinquencies to start to move up, regardless of the type of customer that American Express attracts, the higher end customer. So if you start to see delinquency rates move higher, if you start to see interest rates move higher, that is not positive for American Express. As you said, they're the one that takes the credit risk. So, I get it. I understand why the stock is grinding higher, because there doesn't seem to be any concerns out there. But again, below the surface, all this stuff is bubbling up. Sort of like out there in Yellowstone, you have that what do they call it? Those big giant
The geyser.
no, the geysers, but like all those underground lava fields, like a super volcanoes or something.
Oh, wow. Nice.
Like that.
Yeah, no doubt. All right. And then last thing, Google tomorrow night after the close, is there broader implications for the AI trade, or is this just Google specific because of the underperformance, because of like basically fears of remedies from the DOJ, because of competitive issues of things like Perplexity and the like here? Or does this have the potential to basically make some sort of acknowledgement that the AI trade, the CapEx spend, the growth in cloud, all this stuff is on track? Or do you think it's going to be very Google specific?
I think this is just me. I think it's Google specific. I don't know if you can draw conclusions for the broader AI trade or for the broader economy based on Google. You got a couple things going on here, and we've talked about it, but just to summarize, valuation is obviously compelling at 19 times next year's numbers. It's hard to sort of look past that. And when you back out the cash, it's even cheaper than that. Gemini is not a joke, and YouTube is obviously an incredible franchise. Good for them, by the way. The flip side of the coin is, and you've talked about this, I mean, there is some existential risk that, if they lose search, if AI sort of takes over and Google search sort of goes the way of the dodo, I mean, that's a huge knock. And I think that's a real problem. And then technically, and we've talked about this, and more people are coming around to it, the potential for one of these head and shoulders formations is right there in front of us. So, this 190 level, which it's currently trading at, is vital. So we'll see how the stock trades post earnings. I mean, I think if you're looking to trade this thing into earnings, I would wait. If you get sort of the all clear sign, then that 207 level is going to probably be taken out, and we're going to be off to the races like you saw in Microsoft. If we fail here, that head and shoulders is going to be talked about, and the chance to trade down to whatever that April low was, I think it was about $1.40, is right in the crosshairs.
Yeah, the reason why I started this little earnings conversation with the banks, just to look back and how they're acting right now, is because late last week, Netflix, the stock had barely seen an uptick, right? As we've discussed over the last couple of days, down about 10%. This was one of the massive outperformers, and this was one of the very few tech stocks that did not break that 200-day moving average in early April. But the other one today, Guy, with GM, down 6.5%, talking about $1.1 billion in costs associated with tariffs. Like, this is the one, and we don't have to spend too much time on this, because I just want to highlight this though, because as we get into some more industrials, as we get into some of these companies that are squarely in the face of whether it's steel tariffs, whether it's a focus on Mexico and Canada, all those sorts of things, GM is telling you, or at least the investor reaction right here, giving back all of the gains over the last, call it, month or so in one fell swoop, that this tariff thing is not past a lot of these manufacturers. I keep reading stories about, well, why does the stock market keep making highs? Why are corporates doing pretty well in this tariff environment? It has to do with a pull forward. It has to do with low expectations, that sort of thing. But maybe GM, Guy, is telling you something different.
Well, what they're basically telling you is they can't, or they won't, or they're yet to pass those costs on to the customer, and they're going to eat it. And that's obviously took a huge chunk out of what you just said, and it took a huge chunk out of margins as well. I mean, a huge chunk, and that's problematic. Now, at some point, they're going to have to make a business decision, but they also don't want to find themselves in the crosshairs of this administration. So they're sort of screwed right here. And, this stock continues to sort of be 44, 55. We're in the middle of the range now. I think you wait for a move lower. Maybe you get back to that 45 level, and then we'll look at this trade again, because I do think the administration looks at these names as sort of we can't allow their stocks to go into the, if I may use the term, shitter. And I think and it's not surprising that every time GM trades down to that sort of 45 level, you hear something out of the administration that sort of bolsters the name.
Well, Guy, it's your podcast. You can use whatever word.
Well, I don't like the curse.
I'm just saying. All right, we covered a lot of ground here. Thanks for being with us, people. We will see you back here tomorrow on Wednesday. Thanks.